from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, stocks buckle amidst another shockingly high inflation report. Investors wondering if the Fed will get even more aggressive. We'll talk about what it all means for tech ahead of a key earnings season. Plus, an exclusive conversation with IBM CEO Arvind Krishna. What's his read on the economy and his view on the supply chain? We'll ask all that and more coming up. And the first ads on Netflix will be brought to you by Microsoft. We're going to tell you about the new deal between the two tech powerhouses entering the ad business. All of that in a moment, but first I want to get a look at the markets and another day in the red, no thanks to inflation. Bloomberg's Ed Ludlow here with all the latest moves. Ed, take it away.
Yeah, that's right. CPI for the month of June coming in 9.1% year on year, hotter than expected. That's the thing about equity markets, right? Sometimes they go up, sometimes they go down. Sometimes they don't move at all, and that was kind of where we're at with the NASDAQ 100, ultimately down around 0.1%. But I don't normally do this. This was the session on Wednesday. We start significantly lower, right? Concerns about inflation, that the Fed will have to go further to tackle inflation, inducing recession. It was a volatile session, swinging between gains and losses. Ultimately, we're down. You bring up the next board, Mr. Director, and we look at the breadth of the technology sector, the NASDAQ 100, very tech-heavy index, down in the red, but there were pockets of strength. You look at the Philadelphia Semiconductor Index, or SOX, up 0.8%. Signs from Capitol Hill and D.C. that this administration wants to get going when it comes to fixing the supply chain around semiconductors. NYSE Fang Plus Index, mega caps, up 0.3%, but some of those in the red we'll talk about in just a second. That's as yields pulled back. We are very focused on what this Fed is going to do and what they will not do going into the next meeting. Some tech stories and stocks that are on the move. I'm looking at some names in particular, one of which I like to talk about with you every single day, Emily.
As
Twitter,
much as we can.
Up 8 percentage points. The latest being that Twitter has sued Musk to hold him to the original deal. You and I will dig into that later in the show. Netflix up 1.2%. Deal with Microsoft, who are going to provide the digital infrastructure for an ad-supported version of Netflix. They're going to provide the back end, essentially, the platform for the ads and for the sales. And then worst performing stock on the NASDAQ 100 from a points perspective was Alphabet, parent company of Google. Google, in an internal memo reported by Bloomberg, saying that they're slowing down hiring and that the sunnier days, quote, fingers in the air, are over. Sorry to end on a negative note, Em, but hey, it's Wednesday.
Ed, always can rely on you. Thank you. So what does another round of high inflation data mean for tech specifically? Well, with earnings season about to get underway, I want to bring in Liz Young of SoFi to discuss. So Liz, what are you expecting this earnings season? Is every day going to be like Judgment Day for the next 6 weeks?
I think it might be. And this isn't just tech specific, these comments, but I think earnings season, what needs to happen is that we see revisions downward. Usually things happen in a sequence. And as we've already seen, the market has broken. The market has sent us a signal that there's rough waters ahead, whether that be in corporate America or in the economy. Now we need earnings to kind of meet that signal. And right now we still have earnings expectations through the end of the year of 10 to 11% growth. And in 2023, there's still pretty lofty expectations as well. I think that as profit margins get pinched and CEOs come out and talk to us about their Q2 earnings, they may still have had a strong Q2, but that guidance going forward is likely going to take a hit from inflation, from the tight labor market, from the increase in costs that they've seen over the past 6 months.
But what about tech in particular? Why is tech, or has tech been underperforming the last several weeks?
Well, the last several weeks, I think, have been characterized by a market that's trying to figure out what the biggest problem is and what their biggest fear is. And we've had a lot of trading that has been very rate related. And tech is so sensitive to the rate environment that as we continue to get data that says, you know what, the Fed is going to have to keep going because inflation is still such a big enemy, that hurts tech shares, that hurts those high growth shares. There have been some mini rallies in between. We've seen some attempts at a rally in tech and in some of those growth names, but there's been a lot of give back as soon as the market realizes that the Fed is still on this bandwagon, regardless of the fact that we may have increased recession fears over the next 12 months. In the near term, the Fed is still going to fight that growth narrative.
So let's talk about the signals you're seeing now. Based on what you're seeing, is a recession inevitable?
Well, look, I wouldn't say anything is for sure. Nothing is ever guaranteed. At some point, there will be another recession. That's just how the business cycle works. However, what I will say is that some of the signals that we look at, such as yield curve inversions, now we've gotten a deeper yield curve inversion down 21 basis points as of today, which is the biggest inversion we've seen so far, aside from some of those mini inversions earlier in the year. That's a pretty big signal, and that's the market saying that we're afraid that this hiking cycle is going to take us into recession. Here's what I would say about a recession. Now, we may find out at the end of July that we have another negative GDP print for the second quarter, which would be technically a recession, but it's an odd one, right? It's one where the labor market is so strong. We're still creating jobs. We've got a consumer that's still spending and maybe is frustrated by inflation, but hasn't stopped spending because of it. So it would be a recession that didn't hurt demand to a point enough to bring that inflation number down. Now, what I think the market is grappling with is there a classic recession coming at some point, perhaps in 2023, that does actually affect the labor market, does bring demand down, but it takes care of that inflation problem? So it's the path to fighting this inflation monster that we're all trying to figure out.
Speaking of that monster, how much of a change is SoFi seeing in spending and borrowing habits right now? Do you see customers being resilient in their spending, or are savings shrinking?
Well, look, I mean, with our bank charter earlier in the year, there's obviously a difference that we're seeing, but the spending patterns are pretty consistent across consumers broadly, right? Everybody is still spending. They've just changed their habits. So what you find is, and this is a broad consumer statement, what you find is maybe consumers have pulled back on certain items, and we heard this earlier in the year from some big retailers. Maybe they've pulled back on certain items but started to spend on other items. So you're going to see naturally in a business cycle a contraction in spending in durable goods, but other spending has still held up. We're still seeing in all consumers the desire to travel. We're still seeing airlines that have completely full flights, despite the fact that they keep canceling all of them, but they're still full, and there's still people out there with the appetite to travel. Despite higher gas prices, people are still on the road. So consumers have not necessarily been hit by this yet, but this is much like the profit margin story. Consumers came into this period with a lot built up in savings. They could absorb some of those price increases. Plus, they had such a desire to just get back out there again, which is why we're seeing an inflation in services. Much like companies came into this with record high profit margins, they can absorb some of this into earnings, but they can't absorb all of it.
Now, I'm curious whether or how you're watching this Tesla Twitter story. Tesla is just such a massive stock now, and we're seeing it get caught up in the ups and downs of the Elon Musk Twitter saga. We're just getting some new headlines from the CEO of Twitter in a memo to employees saying they're going to hold Elon Musk accountable for this $44 billion deal every time any news breaks. It impacts not just Twitter stock, but Tesla stock. Do you see an impact on the broader markets here, or is this just a separate narrative in itself?
Well, I think some of this is very company specific because this isn't something that's going on across the entire industry. So at this point, I don't think there's an impact on the broader markets. But as we get through the remainder of the year, if we start to hear things about other companies, I think the M&A activity may pick up later in the year and into 2023, which is not the Twitter and Tesla story, but the M&A narrative could pick up. And what you might find as the economy slows further is that those transactions, those mergers and acquisitions, are now happening because of financial reasons, not because of strategic reasons. So that's something that if we start to hear a theme across companies in certain sectors that have been hit really hard by this, that's something that would affect the broader market.
Interesting. All right, Liz Young of SoFi. Always great to have you here, Liz. Thank you for giving your view on the situation and state of play today. Coming up, IBM CEO Arvind Krishna is here. We'll ask him about his view on the macro headwinds ahead, his view on M&A, and how it's all impacting his cloud and growth strategy ahead. This is Bloomberg. Well, it's long been a bellwether for corporate spending, and these days the view from IBM could be a good indicator for which way the macro headwinds are blowing. Joining us now here in the studio, the CEO of Big Blue himself, Arvind Krishna. Arvind, great to have you here in person.
Emily, always great to be here with you, and this time in person.
In person, indeed. Thank you for taking the time out of your trip to the West Coast. Look, we've got a lot to talk about, but I have to get your view on the macro economy. What scenarios are you planning for? Do you think a recession is inevitable?
I'm actually more optimistic. So I'll caution it with that we are a B2B company, so we tend to see corporate spending. Our customers in turn may be B2C, but we don't directly go to consumer. So in the B2B, we see the spending environment quite robust. We see our demand signals, we see our pipelines, we look at geographies, we look at industries. And part of it may be that technology is the answer through these problems. When you look at supply chain, inflation, labor demographics, interest rates, technology offers you a way to scale without necessarily increasing costs that are linear or worse than linear. And so I think that that is why technology spending, I believe, is going to remain robust in I'll call it all moderate scenarios. If there's something extreme, that's different, but I don't really expect that.
Are you planning for extreme scenarios? I mean, do you have to plan for extreme
We
scenarios?
always plan a bunch of scenarios, but plan is different. That's a plan on paper.
Yeah.
Which ones do you expect to play out? You would say there's a middle, there is a more pessimistic, there's a more optimistic. None of those are the extreme ones.
Well, it's interesting because we're hearing, for example, the CEO of ServiceNow just gave a very pessimistic forecast. Then you have Snowflake with a very optimistic forecast. Like, who's right? I mean, you're optimistic.
I'm optimistic. So I'd say that I see technology spending as remaining above GDP growth. Whether it's 3, 4, 5 points above GDP growth, somewhere in there is going to remain technology, including in Europe, is our view. So we are more optimistic than pessimistic, for sure. And that's why in April, when we could see some of these headwinds that we're talking about were there in April. We did forecast that we would see at the high end a mid-single-digit revenue growth for ourselves at constant currency. So I'll put that to the side.
So how is this all impacting your strategy, your cloud strategy, your growth strategy looking ahead?
It's actually, I think, reinforcing the play we called. So 2 years ago, we called a play on hybrid cloud and artificial intelligence. We see hybrid cloud as helping our clients through these issues. We see AI is really helping on the productivity issue. When you look at AI, $16 trillion of productivity unlock over this decade. And you look at hybrid cloud, $1 trillion opportunity. All our clients want a few public clouds. They still have their own on-premise and private cloud. So when you look at how do you help your clients navigate through all that, really give them a technology roadmap that lets them succeed in the face of sovereignty, in the face of resilience, in the face of supply chain issues. Both these technologies are turning out to be great, great opportunities right now.
Let's talk about the supply chain. Are you seeing relief? How much longer does the supply chain pain last?
I actually may be a bit more pessimistic on that than optimistic.
Okay.
I think supply chain resilience is a real fundamental issue that's going to go on for a couple more years.
And what are the impacts of that?
So I think the impact on the consumer side is obvious. It's going to be higher prices, and you can see that. On the enterprise side, I think that the supply chain is going to cause more delays, more people sort of wondering about where is my alternate on supply chain. But it's not a simple issue. That is what I think nations and leaders have to wake up to. It's going to take 2-3 years for us to go resolve this. And that is why I sort of say this is not a simple issue to get resolved.
So you're saying it's going to get worse before it gets better?
No, I think we may be at the worst of it right now. But when you're at the worst, it doesn't get better right away. That's going to still take a couple of years.
So obviously chips are in short supply, including, we've been following the CHIPS Act. Looked like there was bipartisan agreement that this would get passed. Still hasn't been passed. We spoke to Commerce Secretary Gina Raimondo on Bloomberg Television. Take a listen to what she had to say.
Yes, it will get done. This is, at this point in the negotiation, unfortunately, politicians look for leverage. And while it isn't right to play politics with national security, that's what I think is happening. In the past 2 weeks, we made huge progress. We were closing out issues, finding compromise. So I think everyone just needs to come back today, get back to work, and commit themselves to getting it done in the next few weeks.
So she sounds like she's trying to be optimistic, but she's also clearly frustrated. I mean, you've got companies like TSMC spending $100 billion abroad to increase capacity, and we can't even get a $50 billion bill passed. What's it going to take? Have you been talking to lawmakers? What's your sense of the sentiment here?
We have. So we have been talking to lawmakers on this issue on both the CHIPS Act and USICA for the last year. We are very strong believers that these are good bills for United States competitiveness. We believe in the sake of both national security, but also business in general. These are good things to get done. I think the CHIPS Act is essential.
But will it happen?
I believe the CHIPS Act will happen. I can't predict exactly when it will happen.
Okay.
And which vehicle, will it be part of USICA or part of its own? We are not experts on that. What we can say is that we are happy to put our voice behind the CHIPS Act. We are happy to call senators on both sides. We believe there is bipartisan support actually for these acts. And that is what we are willing to go ask for the support.
Now, you just wrapped your 5th acquisition of the year. With these depressed valuations, is that making you more open to more M&A?
Short answer is yes, but it's not a question of depressed valuation. So M&A has been part of our strategy. About a year ago, when we set out on our Investor Day, we said you should expect us to do $3 to $4 billion a year in acquisitions in a normal year. Now, you can always, when valuations are right and you can get the most attractive target, and it is going to be accretive to us, then we'd be willing to also lean in and borrow ahead from what we can do. You saw a great example of that with Red Hat 4 years ago.
And you just named a new CEO there.
And it has played out for us. And we have paid down the debt we took on to acquire Red Hat. So, but things like that you can do once in a while. But you would absolutely expect us to continue to be acquisitive as we have been.
So are you saying we could see a bigger acquisition like that again, or are we going to be seeing smaller?
The smaller ones are a sure thing. The big one will depend upon both the attractive opportunity. It has to be something that is accretive to us, that aligns with our strategy, and that creates significant synergy. So if you get all those things in play, maybe.
Where could you see some synergies? Like what areas are you eyeing?
The areas we're in are going to be straightforward. Doesn't matter small or big. Yeah. The areas we're on is in software and in consulting. And in both the areas within that, in terms of technology, is around hybrid cloud, around security, around data and AI, and automation, all of which play to the current economic themes of what's going on around the globe.
So speaking of Red Hat, new CEO just named, what changes will this bring?
This doesn't really bring any change. This has been planned for a while. Look, Paul Cormier gave us 4 years since we announced the acquisition. He's not gone, by the way. He's still here as chairman. And Matt has been in his wings for a long time. Matt has worked for Paul for almost 16 years. So we shouldn't expect any significant change. And Matt was the leader behind our OpenShift strategy, behind containers for the last 3 years. He's been leading products inside Red Hat. So you should expect more of the same, more intensity, more of a doubling down on the winners, but not a significant change.
So last quick question. Obviously, you've been at IBM for so many years, but in this CEO seat now for a couple of years and through a pandemic, what are your goals for, let's say, the next 5 years?
Number one is relevance to our clients, and that comes through the areas we have picked. So we have picked our areas, and we're going to keep doubling down on them. That results in revenue growth for the company and results in cash flow growth for the company. That's a return to our investors. Then, apart from that, my goal is clear. We want to build a platform that is going to stand the test of time. The mainframe was a great platform. WebSphere, which was Java, was a great platform. It's time to build the next platform, which is going to be based on the hybrid cloud technologies from Red Hat, but also a lot of what IBM is innovating around that. That will provide a stream of revenue and relevance for 2, 3, 4 decades, maybe?
All right. All right. Big promises. Will be watching. Arvind Krishna, CEO of IBM. So great to see you here in person again. Thank you for stopping by.
Always good to be here with you, Emily.
All right. Much more on Bloomberg Technology ahead. Stay with us. This is Bloomberg.
Whether it's named the Apple Watch Pro or the Apple Watch Explorer Edition, Apple is set to give the Apple Watch a Pro tier for the first time this fall. This follows a strategy that has brought the iPhone Pro, iPad Pro, MacBook Pro, and AirPods Pro to market over the last several years. The Pro Apple Watch will come in the form of a new model that's aimed at extreme sports athletes and just about anyone else simply seeking the most advanced Apple smartwatch available. The high-end model will have a larger and more shatter-resistant display, a rugged metal casing, a body temperature sensor, improved hiking and swim tracking, as well as better battery life. Apple's new watch will likely come in a case size between 46mm and 47mm, up from 45mm on the Apple Watch Series 7 of today. The new screen will also have about 7% more active screen area than the currently largest model. I also think that the new high-end device could replace the Apple Watch Edition and come in durable titanium. Given that a bigger screen and higher-end construction are in play here, I'd guess that the new device will probably start at between $900 and $1,000, approaching the price of an iPhone 13 Pro. For those not looking to pay for an Apple Watch at that price point, there's also a new Apple Watch Series 8 coming, as well as a new low-end Apple Watch SE. The Series 8 will have an updated display and that same body temperature reader, while the new SE will have a faster processor than its predecessor. I'm Mark Gurman. This is Power On.
You can subscribe to Mark's weekly Power On newsletter at Bloomberg.com. All right, coming up, gaming platform Unity doubling down on mobile ads, spending nearly $4.5 billion to acquire ironSource in the face of Apple's ad tracking changes. We're going to ask the CEO of Unity next. Why now for this acquisition? John Riccatello coming up. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Twitter shares jumping, surging 8%, the biggest jump since April. This after that expected Delaware court filing. Twitter suing to hold Elon Musk to his original $44 billion offer. No ifs, ands, or buts. Bloomberg's Ed Ludlow here with the latest. And I know you've been combing through the complaint as well. And
right.
Twitter came out swinging.
Yeah, it's interesting to see the share price reaction, because I think we're both hearing that this is not Twitter sort of trying to get damages or Twitter trying to save face. This is Twitter saying, Elon Musk, we are holding you to the original deal.
Pay up, $44 billion.
$44 billion, $54.20 a share. You know, they're at pains in this very long court document to point out they did hand over lots of information to Elon Musk, and they tried to demonstrate that it was actually Elon Musk that wasn't cooperating. He wasn't engaging with them. He wasn't fulfilling his obligations under the deal. So, yeah.
So Twitter's saying we gave him all this information. He didn't even look at it?
So there are screenshots throughout the filing where they basically say, we engaged with you. We handed over data. We tried to explain it to you. Remember the chronology of events. Last week, Thursday, Twitter executives gave a briefing on how they determine bots. A few hours later, the Washington Post story comes out saying Team Musk just says it cannot be true. It cannot be verified what Twitter is saying. Twitter then come out in subsequent filings saying, we have given you all the data we possibly can. What we're telling you is that a third party can't verify it because we hold both private and public data on this issue. Whether they're right or not, we'll find out in court.
Now, what are the chances that the court can actually hold Elon Musk to this?
Yeah,
and force him to pay up?
This is interesting. We got some breaking news, by the way, after market on Wednesday, that internal memo at Twitter of Parag Agrawal basically telling employees brace for some challenging times ahead. This court case is going to be noisy, he said. There's going to be a lot coming out of it. Most lawyers that Bloomberg speak to think that Twitter have a great case. You know, and so do by the way, the merger arbitrage specialists, these kind of bankers that look at deals and think, what are the chances of this happening? And that's part of why we saw the stock pop on Wednesday, because they feel like we're moving towards an outcome where the deal happens.
So the market seems to think the deal gets done.
Yeah, I would also point out that Hindenburg, a known short seller, came out and said they had a long position in Twitter on Wednesday. In other words, they feel that Elon Musk is in trouble. Their words, I'm paraphrasing, they think that he'll be held to account on it. It all comes back to this phrase, which I've been hitting you over the head with, material adverse effects. And what's really interesting, that chart, by the way, on the screen, that's the spread, right, between the current share price and the $54.20 offer price, and it's narrowed. But what merger arbitrage specialists tell Bloomberg, those deals experts, is that it's not that they don't think the deal will happen at all. They think we're moving to a place where one scenario is he comes back in with a lower price point. And they say they've always thought that. Now it's complicated because Twitter have set their stall out very clearly. They want $54.20 a share.
Bloomberg Intelligence is putting the deal chances at 60%. That's actually quite optimistic, especially in the face of Elon Musk, right?
Yeah, it is optimistic. And throughout this whole period, the probability has swung as low as 30% to, Bloomberg Intelligence is 60%. The question is, what are the unknown scenarios? Twitter does say...
Which, whenever you're dealing with Elon Musk,
is always
there
a
are
possibility.
many unknowns.
Settling out of court is a possibility. Settling a lower price point is a possibility. Those that I'm speaking to basically feel like Elon Musk has used up his leverage because he made some very public tweets, and ultimately a court of law will decide this one.
Right.
We think
it's all there.
Yeah.
In 280
literally
characters.
black and white. Yeah.
Exactly. Okay. Thank you for combing through that for us. Appreciate it. All right, meantime, gaming service provider Unity Software is spending upwards of $4.4 billion to buy IronSource to help boot up its advertising technology. The all-stock deal sent shares of IronSource, which went public via SPAC last year, soaring by nearly 50%. Shares of Unity, on the other hand, fell by double digits today. There you see it. But Bloomberg Intelligence sees the deal as a real opportunity for Unity to expand its reach in advertising, particularly in-app mobile ads. Here to discuss it all, Unity CEO John Riccitiello. John, great to have you with us. Look, John, you've been in the gaming industry for decades. What do you have to say to investors who are skeptical that this deal is actually good for you?
Well, a couple of things. I think we've set out a vision for precisely how this merger, this deal, will help us make sure that our customers can make better games and make a better business. And when we improve the business of our customers, we're going to do well. We also set out 3 very specific synergies where we're going to realize benefit right to the bottom line. And we framed out that we expect to see EBITDA run rate in 2024 at $800 million. That's a lot for a company of our scale. And we really gave it to them precisely that. Look, M&A in a day when the market trades down, there's a lot of things that happen. My job is not so much to think about, what my stock trades at tomorrow, but to make sure that we're building a company that is going to be super valuable in the long term. And as investors, get comfortable and understand our story, but also see it in the results, I have confidence that we'll be fine.
So how big an impact did Apple's ad tracking privacy changes have here?
Not at all, actually. So, these were well understood well before we considered, looking at IronSource. And as we've reported, there is durability and long-term viability to the iOS side of gaming advertising. I mean, look, it's a huge market. Only about 3 to 5% of applications are paid for by the consumer. 95 or 97% of consumers don't pay. Hence the need for advertisement. Here's a real important trick. In almost no industry do users or players or viewers think that advertising is a positive. One of the only industries I'm aware of, in the gaming industry, mobile gaming in particular, they tell us time and again that they think the advertising is positive. And not only do they say it, we can prove it, because games with advertising, when they're tested against those without, achieve higher levels of engagement, and it means they're playing more. And so we know this is true. I think it ought to be the envy of everybody in the advertising world. And of course, it's performance advertising. So our customers, what they get from us is return on investment. Maybe they want to spend less and sometimes against the recession, et cetera, but they don't want less ROI. And that's what we deliver.
Interesting. Now, Unity did have a round of layoffs recently. You cut your guidance for the full year. Are those kind of issues behind you, given the macroeconomic headwinds we see ahead for every company?
Well, first off, I mean, let me just talk a little bit about the layoffs, because I think they were somewhat blown out of proportion, not by you, Emily, but some in the press. We're a company of about 6,500 people. We eliminated about 250 positions, and we offered half of them new roles for, that would be a better career opportunity for inside of Unity than outside of Unity, or inside of Unity versus what they were doing previously. And then for each and every one of those individuals, look, I take it, it's important to make sure that everyone is treated well, and we treated them super well. A loss of that number of jobs in a company of our scale through to focus. Look, we're not in theory, the government where everything lives forever. Some things are working better than others, and we reallocate to optimize our approach to market and the opportunity in front of us. So, look, I think it's always unfortunate when even one person loses their job. What I'm proud of is we did it in a way that I think was as positive for those involved as it could be. Everyone was given an opportunity to talk to us about what they might want to do. About half of them were able to offer them something, and a lot of them are going to end up right back at Unity, because this is a great place to work.
So I know you're expecting this deal to generate $1 billion in adjusted earnings. Will that still happen if there's a recession ahead? And do you think a recession is inevitable?
Well, look, I think one of the things that always happens anytime when business shows start talking about the Fed is the only thing that's truly in great supply is pundits. And so, I don't want to get into a position of trying to be a pundit. There's definitely some evidence of a slowdown, whether it will register as a full-scale recession. But here's something, I don't know, but I will point out a couple of things. Certainly economic cycles affect businesses. But if you go back over the last 20 to 30 years, and you look at each and every time we've felt recession, one of the industries that fared the best is the gaming industry. Lots of reasons for that, but it's a relatively inexpensive way to entertain yourself. And it's one thing to get into a game and see an ad and end up buying a $1 in-app purchase. It's not maybe the same thing as buying a new, F-150 pickup truck. And the other issue is this advertising medium is performance-based. So to the degree that, recessionary things happen, they're always going to buffet industries. I think this is an industry, this is a sector that will be buffeted far less so. So we feel confident in what we outlined today, or we wouldn't have said it. Crystal balls are never perfect, but we think we've got the right collection of assets. And in this instance, we're strengthening our hand in combination with Unity, we can, and Iron Source, if we can help our customers make better content and have a better business, we know there's long-term success in that.
All right. Well, thank you for giving us your view into your crystal ball, John. Always good to have you here. John Riccitiello, CEO of Unity. Appreciate you stopping by. All right. Bill Gates is donating $20 billion to the Bill and Melinda Gates Foundation this month. The foundation has a new goal of increasing its annual giving by 50% to $9 billion a year. Gates' latest donation brings the foundation's total endowment to about $70 billion. Coming up, did the collapse of one of the largest crypto hedge funds spur the crypto sell-off? We're going to dive into this week's Big Take next. This is Bloomberg. rise and fall of Three Arrows Capital is shedding light on the obscure practices of some crypto firms. They bet on prices only going up. Known as one of the largest crypto hedge funds in the world, 3AC invested in some of the best-known blockchain startups. But when crypto prices turned this year, 3AC unraveled and may have even accelerated the decline. That is the topic of this week's Bloomberg Big Take, titled When Hold, spelled HODL, failed, the collapse of Three Arrows. Joining us now, our Bloomberg crypto reporter, Muyao Shen, who co-wrote this piece. So talk to us about the most dramatic twists and turns in this fall.
I think the most dramatic part is that how a very well-known hedge fund in crypto just failed all of a sudden. I think this is such a surprise to so many, unlike a lot of our previous failures in crypto that people inside crypto in general were aware of. So
did the collapse of Three Arrows really or cause or lead to potentially the broader crypto contagion?
What are we seeing so far? There's a definitely contagion in crypto market right now. We've seen some of their biggest counterparties. For example, the Canada-based Voyager Digital, they announced bankrupt as a result of their exposure to Three Arrows, who borrowed tons of money from Voyager and was not able to fulfill the obligations.
Talk to us about the role of transparency here. I mean, were they really only betting that crypto was going to go up? What hedge fund does that?
That's I think one of the most thing I personally find very surprising throughout the reporting part of this story is just that these two people were former Forex traders. They're supposed to be very intelligent, sophisticated traders in crypto, but it turned out literally every single person I talked to told me they're the biggest bulls in crypto, and they believe this kind of theory of super cycle that crypto would never fall like other markets, and they put on big bets on every single project they invested in.
So how does the crypto market move on from this? Obviously, it's not just Three Arrows. You know, we've seen the collapse of Terra, and it's really scared off a lot of investors.
Yeah, I think, as you said, this is the transparency issues and there's a trust crisis in crypto right now. So I think moving forward, I think this market, this space really needs to be more transparent. For example, all these big lenders, they need to communicate with each other, talking about who's borrowing money to whom to make sure none of their counterparties are going too big to a certain extent that are going to have more impact across the market.
All right, well, I'm sure that we will see more tumult ahead. Bloomberg's Muyao Shen on this week's Bloomberg Big Take. Thank you. Coming up, Netflix picks a partner. As part of its strategy to rack up new subscribers, the streaming service is offering a cheaper option with ads, and another tech giant has signed up to help. That story next. This is Bloomberg. Welcome back to Bloomberg Technology. Netflix has chosen Microsoft as its tech and sales partner for its new ad-supported streaming service in hopes of advancing its efforts to reignite subscriber and revenue growth. Joining us now, Bloomberg's Lucas Shaw. So, Lucas, what are we learning about this new tier, if you will?
Well, Netflix still isn't saying an awful lot about how it will work for its customers. We don't know if there'll be ads before a show starts, in the middle of a show, both of them. We don't know how many ads. We don't know the price of the ad tier. The only thing we know at this point is that they're relying on Microsoft for a lot of the back-end work, not anything that the customer will see, but it'll be Microsoft's sales team that sells the ads, and it'll also be Microsoft's technology that will handle the serving of the ads that we all see. It's a big win for Microsoft, which is not as big a player in the video ad space as, say, Google or Comcast.
Right. It was news to me that Microsoft had a burgeoning ad service. How is this a step towards some broader goal here of, taking on some of its competitors?
Yeah, I mean, Microsoft, I think, said that last year its ad business was about $10 billion, which is as big as some of the big kind of the TV-based media companies, obviously not as big as a Google or a Facebook. It acquired Xandr, which is this ad business that AT&T had built up last year in a deal that was estimated about $1 billion. Xandr is not, say, the best in class, but did try to compete with Google and Facebook. Obviously has LinkedIn, and so it's building a pretty robust ad business and wants to compete with players like Amazon and Google and Facebook.
So here's the question. I mean, we've heard over and over again, content is king. It is all about the content. Is it really all about the content, or is an ad-supported service that is somewhat cheaper really going to make a difference when it comes to racking up subscribers?
I think if you're Netflix right now, you now have about 220 million customers. They say that each one of those subscribers is really like, say, 3.5 people. So they're already at like 600, 700 million people who are using their service. There's only so many people who are going to pay for it. This ad tier helps them on a couple fronts. One is it could appeal to some people who maybe don't want to spend quite as much money. And in some of these cases, these ad-supported services actually generate more money because people are paying a monthly fee, and if you can make a lot of money from the advertising. Netflix is associated with quality programming. They need to both find ways to keep increasing the customer base and make more money from those people. This could do both. It's the same reason that they're trying the kind of what they call the crackdown on password sharing, because if they can get other users to pay more who are already using Netflix, that's a win for them.
All right, Lucas Shaw, thank you for your reporting here. We'll keep watching. Meantime, I want to end the show with some news out of Tesla. The EV maker's AI and autopilot chief says he's leaving the company. Ed Ludlow back here with more. Obviously, this is a critical role.
Yes, this is Andrej Karpathy. He's been at Tesla since 2017, but he went on leave in March. And, sources have told me this was a guy that didn't miss a day of work for 5 years. He went on leave. He's tweeted that he's leaving Tesla, in strong, capable hands. Autopilot, the work Tesla's done on AI to power that camera-based technology has really come a long way. But he's doing something new. We just don't know what.
So do we know if this had anything to do with disagreements or a deprioritization of the work that he's doing?
We don't, but you'll remember last week we reported that Tesla laid off around 230 autopilot data labelers, as part of the big layoffs program. They have made progress in this area. They're working on their own chips, their own supercomputer dojo to help the AI train the neural networks to improve this technology. But he's been on leave. We don't know what's going on behind the scenes. And now he's called time on his Tesla career.
So just another problem for Elon Musk,
Another
apparently.
one, but Elon tweeted he's grateful for the time he had.
What has Elon said so far about the Twitter suit? Have we heard from him?
He tweeted, "Oh, the irony, lol."
Gotta get a lol in there.
This is cutting edge, yeah.
So look, how are we expecting this story to progress? In terms of moving through the courts, when are we going to see another development? We've seen Twitter's salvo. When are we going to see a salvo?
Two school of thoughts. Musk countersues. It could go to trial, move very, very quickly, or we are going to have a very protracted legal dispute between the two.
It's already been protracted.
I mean, in court for years, some are bracing for.
Really?
Yeah.
So what happens to Twitter in that time? I mean, what about the uncertainty?
This is a real financial headwind for them. It's a financial and public relations headwind, but
headwind for employees. I mean, they're trying to recruit people, get people to stay at the company and keep the trains running, right?
Exactly so. And that was part of what Twitter CEO Parag Agrawal said to employees on Wednesday. We're facing a changing economy and this court case. Brace yourselves.
What are we seeing? What are we hearing inside the company from employees? I know you're talking to a lot of people.
They're not that impressed, right? They feel like Twitter's management have been on the back foot this whole time, that they should have been more proactive, that Elon Musk's all hands a few weeks ago just was kind of the icing on the cake, is not the right word, the final straw for a lot of employees. And they've frozen hiring, they've cut projects. It's not as happy a place to work right now. But there's fighting talk coming out from management and the board.
Indeed.
So sometimes fighting talk gets you going.
Fighting words, indeed. All right, Ed Ludlow, thank you.
Sure.
Well, that does it for this edition of Bloomberg Technology. Tomorrow, we're going to be joined by Maven Clinic CEO Kate Ryder. She's going to talk about the role telehealth will play in the state-by-state debate since Roe versus Wade was overturned. And don't forget to check out our podcast. You can find it every day wherever you get your podcasts, on the terminal, Apple, Spotify, iHeart, Google Play, and more. I'm Emily Chang in San Francisco. This is Bloomberg.